Good morning, everyone. Thank you for joining us. It's about 3 minutes to 9, so we're just going to hang out here and wait for others to join us. But in the meantime, I'll let some of y'all get a jump on it. If you do need continuing education credits for attending this webinar today. If you want to put your name and your email address in the chat, we'll be recording those and get certificates out to y'all. So my early birds, if you do want those CEUs, please pop your name in our chat and your email. Thanks to everyone. I see some of you are starting to put your names and emails in the chat that want those CEUs, so I appreciate that. And welcome back. I see lots of familiar names and faces on here, so appreciative of y'all joining us and some of you guys coming back for more conversations and discussions. So a couple y'all have joined maybe since I said this last, but if you would like continuing education credits for today's webinar, please drop your name and your email address in our chat so we can get that noted down and send you certificates for that. So I see lots of you doing it already, but if you haven't, please do that if you need those. It's 9 o'clock on the dot. I'm going to give it exactly 1 more minute for people to join because I do see a couple people trickling in, and then we're going to get started so that we can stay on time here this morning. And I don't want to cut into y'all's time to ask us questions or things about today's presentation. So thanks y'all for being here, and we'll get started in 1 second. All right, I'm gonna get this show on the road, and if other people trickle in, that's great. So good morning. I'm Allie Rellinger, and I really want to thank y'all for coming this morning to our Understanding Risk Rating 2.0 virtual training workshop. And so I'm here today with some of my other colleagues from the Mississippi Alabama Sea Grant, Stephen Deal and Kiama Williams. Many of you have met all of us at different in-person and virtual events. So we are all part of the resilience team here at the Mississippi Alabama Sea Grant. And so this is part of our Coast Leadership Program where we're working on trainings for this entire, well, all of 2024, and now we're in 2025. So we're going to be continuing series of workshops on resilience topics that were guided by asks from people like y'all when we reached out to all of you and said, what do we want to talk about? And Risk Rating 2.0 keeps coming to the top. So we're doing this. We've done it in person a couple times along the coast, and then we decided to do it virtually here today. And joining us, we have our guest speaker. We have Stephen Songe here from Songe Insurance Agency, who really knows all about this and is here to help guide us through some of the nuance and intricacies around Risk Rating 2.0. So I am going to kind of kick things off a little bit and just give you a little more background on the conversations that led to us wanting to do this training and what we're kind of hearing in the community as like Sea Grant extension agents and why the need for this really exists. I have to be able to advance my slide first. There we go. Okay, so first of all, a little background on Risk Rating 2.0 to make sure that we're all kind of on the same page about this. Okay, this was fully implemented in April of 2022. So this has been rolled out fully for a couple years now, but this really represents updates to the way the National Flood Insurance Program calculates their rates. So it's called Risk Rating 2.0. And really, this is one of the biggest updates we have seen to the National Flood Insurance Program's way they calculate their rates. It's really been fundamentally unchanged since the 70s. So this was a really big paradigm shift within the National Flood Insurance Program for how we calculate these rates. So after decades of basically the same sort of thing going on, then we had this rollout of this completely new way that this was done. And this is led to just a lot of questions, some confusion, and lots of interesting discussion points about how we use this going forward. So I've created this little schematic that kind of summarizes what the public perception that I see in my job of like talking to, average people about their understanding of the flood insurance program. And so you'll see on the one side, I have what I call the legacy rating system, how we did things before Risk Rating 2.0, and kind of then highlighting the changes that have happened within Risk Rating 2.0. So you see our little community. My office is in Biloxi, Mississippi. I happen to live in Ocean Springs, and we work all along the coast. So I think most coastal community residents are kind of understanding of this idea of we have a flood zone and no flood zone. These are not technical terms, but the average person will be talking about things. Oh, I don't live in a flood zone. Oh, I do live in a flood zone. And we know that under the legacy rating system, when it came to flood insurance, then people's perception was then if I don't live in a flood zone, it's cheap for flood insurance. And if I live in a flood zone, it's more expensive. And then depending on their level of understanding engagement, they might understand something about like a base flood elevation and that like you basically need to be above this kind of, magic line that tells us all of this. Of course, there's lots of technical underpinnings to this, but this is kind of how people think about it. The other thing that people tend to know is that whether you're required or not to carry flood insurance. So if you have a federally backed mortgage and you live in a quote flood zone, then you're required to have it. And if you don't, then you're not. So you see lots of realty listings and people talking about moving to an area and that I don't want to live in a flood zone, and you'll see no flood insurance required, things like that on real estate listings. So people seem to know that it's tied to how much it would cost and whether or not they need to have it. But with Risk Rating 2.0, things have changed a bit. First of all, it's changed that how the rates are actually calculated. It's not as black and white as it used to be. And so we see that risk, the whole risk rating name is about distributing that actual rates to more accurately match risk. So knowing that even within a flood zone, there are houses that are more have more risk than others, and so you'll see changes across that. And then outside the flood zone, people who maybe live kind of on that edge. I personally am one of those. You know, I houses in an X flood zone, 3 doors down is in AE. So people like me have more risk. This makes sense than people further away, you know, from the coast. And so we're seeing a change in how these rates are proportioned out. Things that did not change, though, is the requirement to carry flood insurance. So even though the rates have changed around this, you still have this flood zone, no flood zone designation on whether you're required to have this flood insurance. So there's pieces of the things that haven't changed, and then there's new rates and things that have changed. And so this has kind of muddled up people's understanding of what's going on with the legacy system and then moving into the rates we see with risk rating 2.0. So other things that have caused a little confusion over time is that once Risk Rating 2.0 came into effect in 2022, we didn't see immediate rate hikes up to our new full cost. There is a cap on that. It's an 18% annual increase for existing policies. That started in 2022, so we're well into seeing those you know, steps upward. So people have definitely noticed that this is happening and their rates are going up over time. New policies do come in at full rate though, so people that are shopping and are new to the market have seen the full rates coming into effect and their pricing. And until recently, there's big conversations about rate transparency. There was no easy way to get a quote. They just rolled out a new policy quote tool so that you can actually get those on your own to some degree. We've started to play around with it a bit. It came out in November, so it's a fairly new tool. You know, I've seen some examples where, like, personally, I've seen a few where the quote tool gave me something higher than I know that the person their actual quote has been, or others have been really on par. So hopefully today's presentation, as we talk about that, and I pass this over to Stephen, you're going to see a lot more about what goes into this risk rating 2.0 calculation and understand the nuance and why, you know, working with an insurance agent to see all the different things that could be put into that calculation and what we need to be aware of. So that has kind of shifted. So just know that there is a new quote tool available that you can play with. So one thing that's been a little confusing for people who, if they already carry policies, and we have a lot of conversations about, is just understanding where they're going with their rates. And so, like I said, they're noticing that 18% jump per year. You know, that's a fairly large jump. So they've been seeing it over time. But I spent a lot of time helping people look at their insurance, like declaration pages and things, and then showing them. So I've highlighted an example here, you know, where you can see what they actually paid today and then where they're going is in this full risk premium. And so this can be a little confusing for people as they're budgeting and they're planning and they're figuring out what's going to be happening with their flood insurance under risk rating 2.0. So the other questions and concerns that kind of led us to this conversation is some of the lack of transparency on the models that have been used to calculate these new rates. So you're going to see all the pieces that we do put into that, but there are still some questions that, you know, we don't have full access to the models that they're using to understand how rates are being calculated. There are conversations about the lack of subsidies that do go into this from an equity side of things. So that's a big conversation in many of our lower income community areas on these giant rate hikes for some people. We also have seen a drop in NFIP policies. So that is of concern to people doing resilience work, is how is risk rating 2.0 changed who is carrying flood insurance? Then elephant in the room, there are multiple lawsuits. We're not going to get into any of that today, but acknowledging the fact that there are lawsuits that have wrapped up and are still ongoing. And then I didn't actually update that bullet point about the no public facing premium calculator, but we do have a public facing premium calculator now. So I need to cross that one off the list. So, when it's all said and done, there's a lot of different ways we can think about risk rating 2.0 and our intersection with how this plays into our resilience that have led us to want to have this conversation and really make sure that everyone knows what goes into understanding risk rating 2.0 calculations. I'm going to ignore those. And then I just want to, before I pass it over, leave you with, some statistics on risk rating 2.0. I've put Alabama, Mississippi in here because we're obviously the Mississippi Alabama Sea Grant. Lots of our friends over in Florida do have lots of conversations with us, so I included that in here. But you can see that there are statistics for every state that you can look into that show how risk rating 2.0 has changed policies, who has seen decreases in a state, who's seen little to no change, and who's seen the more extreme changes in their policies to get an idea of how this has changed in a state. You can also drill this down into county level and things like that. So there is a lot of interesting data out there available that we can kind of play with and look to see what's going on in your particular community if you're interested. And so with that, I'm going to stop sharing my screen and I'm going to pass it over to Stephen so that he's going to tell us all about how we actually go about getting this rate calculation and all of this nuance of this risk rating 2.0. So I'm going to mute myself.
Well, wonderful, wonderful. Good morning, everyone, and thank you, Allie. So let me get set up here. All right, hope everybody can see that. So I am just a little bit about me. Let's get this to go here. Okay, so a little bit about me. I was raised on the Mississippi Gulf Coast. I've been in the insurance industry since 1988. I've spent 24 years in the claims industry, handling auto, homeowner, commercial policies, also handled flood losses for the NFIP. I've lived and worked in Florida, Louisiana, Texas, Oklahoma, Tennessee, and then came back to Mississippi in 2003, just in time for Hurricane Katrina. I was the property claims manager over the state of Mississippi and Arkansas, South Alabama, the Florida Panhandle for Nationwide Insurance Company. Was a catastrophe coordinator for Hurricane Katrina for Harrison and Hancock counties after that hurricane. And then I became an agent in 2012. I was with Nationwide for 4 years, had an Allstate agency for a year, and then became an independent agency in 2017. Our office is located in Ocean Springs, Mississippi, and we handle all of Mississippi and Alabama. So today we could spend hours talking about FEMA, National Flood Insurance Program, but what we're primarily going to focus on today is the risk rating 2.0 system. What are some of the rating factors? What I'll do is bring you along on when we get a call from a customer, how we actually rate, the questions we ask, and going into the system and how we actually rate that. Also, we'll talk about some things that we're seeing on the Mississippi and Alabama Gulf Coast as it relates to flood rates, what we're seeing in different zones, and then talk a little bit about the National Flood Program versus private flood companies, which are coming into the area. And I think what Allie alluded to earlier about you seeing that 20% decrease in flood policies within every state, a lot of that has to do with private flood companies coming in and absorbing some of that loss to the federal programs. So just to kind of recap what Allie was saying, when this started a couple of years ago, one of the things that changed from, or a few things that changed from the legacy program to the new risk rating 2.0 is that you're no longer required to have an elevation certificate to get a quote. Now that there are some benefits to having one, which we'll talk about in a little bit, but in order to get a quote and to get a policy, you do not have to have an elevation certificate. Grandfathering is also, they did away with all grandfathering. So continuous coverage, if you had a policy prior to the flood map change, which most maps changed around 2009. If you had a policy before that, you kept your policy all the way through, as long as it was continuous coverage, you got to keep the rates from those prior maps. Built-in compliance is if you had a house that was built in compliance with prior mapping, you were able to rate it under the mapping for those, or the rates for those maps. And then preferred rates, which if you were in an X zone instead of an AE zone, you were getting preferred rates because you were in a non-high hazard zone. So they did away with all of that on the risk rating 2.0 system. Rates are no longer based on a zone, which we'll talk about how they're factoring it now, but it doesn't matter if you're in an X or an AE or a VE zone. That zone does not affect how your policy is being rated. And it says and the base flood elevations, but base flood elevations do play a role in the rate. But you'll see as we go forward how that works. Individualized rates now, that they're basically, that just means they're basing it on your location, the type of construction of the building, and some other factors that's specific to your property. Also, they're pulling in RC valuations. They're making sure that your policies are based on what the full replacement cost value is of the building. And then the application process is a little different than what it was under the legacy rates. What hasn't changed is the mandatory purchase requirement, and that's basically by the lender. So if you're in a high hazard zone, an AE or a VE zone, the lenders are requiring policyholders to carry a flood policy. That if you own your house and you don't have a loan, you don't have to have a flood policy. That's just up to you. The insurance flood rate maps have not changed. They're still the same. Letters of map adjustments and map revisions, that still remains the same. Policy assignment. So National Flood Program policies are the only policies, insurance policies, that you can transfer from sellers to buyers. So if somebody has an existing policy, they can transfer that policy, and when they sell the house, to the incoming buyers. Allie touched on the 18% annual cap rate increase. That's basically still the same. And then increased cost of compliance, community rating systems, and building codes. Basically, if you have a house that's in an AE or a VE zone, building codes are going to require that you build above base flood elevation. And a lot of times you're required to have an elevation certificate for that, but that doesn't have any effect on your rates as an insurance policy. That's just, they still, all of those systems and compliances for local building codes are still in force. So just a little bit of terminology real quick. When someone says they're not in a flood zone, everybody in the United States is in a flood zone. It just depends on what zone you're in. Are you in a high hazard zone or low hazard? VE zones are basically high velocity zones. That's where you get wave action. AE zones are where you have a higher chance of flooding. And then X zones are where it's the lowest. It doesn't mean you're not going to flood. It just means that there's a very low probability that your house would flood. Base flood elevations is basically, it is a 1% annual chance that area is going to flood above that level in a 100-year or 500-year time. So that's what your base flood elevations are. When we talk about some ratings, whether a house is here, you see where it is above the base flood level, the bottom floor is above base flood level, or it's below, that does have an impact on your rates. The map panels, like we said, those have not changed. This is when you go on to FEMA's website, you can go to FEMA.gov and the rate and look for the flood maps. You can pull up an address and these maps will show up like this. It tells you what the community numbers are. It tells you when those dates were changed for the flood maps. Also gives you the map panels, and you can see it's set up like a grid, and you can go to the different map panels. But when you run an elevation certificate, they need to know what panel you're in and so that they can determine, what your flood elevations are at that point. Everything's topographical, so it follows the contours of the ground. And when you zoom in on that map that we looked at before into a certain panel, you can see where the maps are. So if you're in a blue shaded area, you're in a high hazard zone like an AE or a VE zone, and the map will tell you. So in certain areas you can see, like for instance, one area is in an AE zone, and you can see the elevation in that point is 17 feet above sea level. The areas that are in brown or that have no shading, that's primarily an X zone. And then you can see as you get closer to the coast, the VE zones where you get the high velocity wave action zones. So let's look at whenever we get a call and we start to run a quote, basically we go into, there's a few systems that we can run, but this is Torrent flood quoting system. A lot of companies use this, write your own companies use them. And so we utilize this, and it asks all the questions that are necessary for risk rating, to get it under the risk rating 2.0 system. It's some of the stuff auto populates based on what we put in there. But in this case, starting off with a quote, the first thing we do is we look at, what is the effective date of the policy. If it's a loan closing, there's no waiting period. You just put it for whatever the date that you're closing on the house. If it's not a loan closing, then there's a standard 30-day waiting period from the day the policy is paid. So once we issue a policy and get it paid, policy will go into effect 30 days later. So once we put in a standard 30-day wait, the 30 days will automatically show up in the effective date there. We put the person's individual's name in there. You can see this is for Cecil Highwater. And then we'll put some personal information in about them, their phone number, address, email address, and then we plug in the address. And once we put the address in there and it matches up that address in the system, we can't change that address because it's pulling that from outside sources. And then you can see there's a little notice that'll pop up that says, selected fields have been auto-populated based on property address entered. Please validate the indicated fields as an edit is necessary. So basically, FEMA is pulling information from outside sources now, from whether it's government sources, local web access, or what have you, or pulling up like from Zillow and some of those factors on valuations, and it's pulling up your latitude and longitude to specifically pinpoint exactly where that property is. So some of the changes that we've seen in risk rating 2.0, like we talked about, it's no longer based off of the zone that you're in. It's your distance to a flooding source. And that could be the Gulf of Mexico, that could be a lake, that could be a runoff area, it could be a river. It just depends on how close you are. And so the closer you are to some of these flooding sources, the higher your rate will be. Now, what we've seen is you could have some people in X zones that are right next to a river. D'Iberville has a subdivision that's right north of the interstate off of 67. And there's a subdivision up in there that's right along the river. And most of that's in an X zone, but their rates are just as if you were sitting right on the Gulf Coast, right on the water. So it just basically depended upon where your house is in relation to a flooding source. So once we plug in the address, one of the things that we can do is we look up the flood zone in the community. We click on this button for the flood zone determination, and it gives us that information. So if you're in an AE zone, it'll give you all of that information. It tells you the community number, the current map panel, and then the map suffix, and then what zone it's in. In this particular case, it's showing this in an X zone. Now, if you're in an AE zone, again, you don't have to have an elevation certificate to get the quote, but if you have one, it can give you some discounts, and we'll talk about that here in a moment. So the occupancy is another rating variable, a rating factor. If it's a single family dwelling, primary home, family lives in the house, you're going to get a rate that's a little bit lower than what it would be if it was a manufactured home if it was over a 4-family building, a condominium building, commercial building, or anything that's non-residential. If it's a home that's being rented to like an investment property, then those rates there's a surcharge that goes on there that will make that rate a little bit higher. So if it's a primary home, you're normally getting lower rates than what it would be if it's not used as a primary dwelling. So here we indicate if it's owner or tenant occupied, if it's a nonprofit entity, if it's a small business, if it's a rental property, if it's a condominium association. If it's a owner occupied, there's a $25 surcharge on the policy. If it's anything other than owner occupied primary dwelling, then there's a $250. So the difference in premium is about $225. The occupancy, we indicate that it's a single family home. And then they ask, will it be occupied more than 50% of the year? That's where you get into your primary or secondary dwellings. Again, this is a main dwelling. If it's a detached guest house, there are questions in there about, are there any other structures on the property? Just know that on the National Flood Program, when you get a policy on the main building, it only covers the main building. It doesn't cover sheds. It doesn't cover guest houses. You have to get separate policies for those buildings that are on there. The next thing they ask is about the foundation. So this is a big factor in the rating of the property. So these are primarily 4 of the types of foundations that we see on any given property down here on the coast. You're normally going to have a house that's on a slab that's sitting on grade. It could be an elevated slab where you have a chain wall. They basically put a perimeter concrete wall, and then they fill it with dirt and then put a slab on top of it. That's a chain wall. That's still considered a slab on grade as far as FEMA is concerned. You have a crawl space where if it's less than 5 feet, we would just rate it as a crawl space. Elevated without any enclosures underneath it. We see a lot of those as you get closer to the water. And then you have elevated with an enclosure underneath it. And we'll talk a little bit about that enclosure and how they rate whatever they consider to be your bottom floor. The construction type of the home, again, this is where they talk about individualized rates. The construction type based on that specific home. So these types of terminology for the construction types kind of follow along with in the insurance industry, how they determine construction qualities for commercial structures. So the frame buildings would be made of wood or metal frame walls. It could be a brick veneer. So if you have a brick veneer house, that's still considered a frame house. Masonry would be similar to homes, like I think there's some homes up in Turtle Creek subdivision that's in Gulfport or North Biloxi that they actually have poured concrete walls. So that would be a masonry wall. And then there's other types of construction as well, but primarily we see frame and masonry in the coastal areas. So again, that's what we're talking about. They want to know if the house is built over water. What is the construction type? And again, we're getting back down into the individualized rates. What is the square footage of the home? That's the living area. So they want to know that for valuation purposes. How many floors are in the building? These are living areas. It doesn't include areas underneath the house, but it does include a finished attic or does not include finished attics that are in the top. Number of elevators. If you have elevators, that can affect how discounts for machinery and equipment. And then the number of detached structures you have on the property. They just want to know if there's any others on there, because if there are, you may need to get another policy for that. The floor height. So again, when we run a quote, we plug in the information for the home, and it'll automatically tell us what their rate's going to be based on what they're pulling from GIS systems from other outside sources. So they're already factoring that the house is, if it's listing online somewhere as a house on a slab, they're already factoring that in. So, but the elevations of a house is used to determine rates for all policies. And they use that elevation in relation to your base flood elevation. And it's always based on whatever the bottom floor, that's what they're rating it off of. So there's two ways to determine the floor height of a property. Here's a couple of examples right here. So if you have a house on a slab, the top of the bottom floor is the top of the slab. So that's what they're rating it off of. So whenever you get an elevation certificate, or if you do get one, they want to know what's the height right at that level. If you have an elevated house that's up on piles and there's nothing underneath it, then the top of the bottom floor is the top of where your subflooring starts right there. So where the arrow's pointing there. So that has a big impact on how they rate your policies. Again, these are foundations examples again, but the bottom right shows a home that has a enclosure underneath it. So if there are no enclosures, they're rating it at the top floor of the house. If you have an enclosure, they could rate it at that bottom of that enclosure. It just depends on if that foundation is properly vented. Now, these are homes that are in high hazard flood zones, whether it's an AE or a VE zone. It doesn't really impact X zones, but when you're in the AE zone, if that bottom level is not what they call properly vented, then they could consider that as being your rating floor, the bottom floor that they're going to rate. And that could be the difference of being below or above the base flood elevation. So flood vents, when we talk about venting, these are what vents look like. You've probably seen them around the bottom of a house where it's basically an opening that allows water to come in and out. If to be properly vented, you have to have a minimum of 2 openings. They have to be on at least 2 exterior walls, and the net area of those openings cannot be less than 1 square inch for every square foot of enclosure. So if that bottom enclosure is 200 square feet in area, then your openings have to be more than 200 square inches combined. And then the bottom of the opening, they can't be more than a foot above, basically above grade on the exterior or interior grade. When you get an elevation certificate, it'll tell you what those openings are. Like in this particular case, there's 3 openings and they equal 300 square inches. It asks if they're certified engineered openings that are used. A lot of times that they are. It gives you a little definition down there about what those are, and you can look at the FEMA NFIP manuals on what those are. But primarily, it just has to be an opening that allows water to go in and out and it's unobstructed. Discounts. So you can get some discounts for your machinery and equipment if they're all located above what they consider to be the bottom floor of the house. So in this particular case, let's assume that this particular house is elevated with an enclosure underneath. Let's say that it is properly vented, and then what they consider to be the top of the bottom floor is basically the bottom floor of the house. So the first question it asks is, do you have clothes washers, dryers, freezers, things of that nature, refrigerators that are all above that level? If you have those and they are above that level, then in that case, you can get a little bit of a discount on your rate. Same thing with your equipment that services the building, like air conditioning units, furnaces, heat pumps, water heaters, elevators, machinery and equipment. If it is all above that level, then there are some discounts that are provided. For homes on a slab, they look at it a little bit differently. They consider it to be the level above the first floor. So in this case, it asks, do you have washers and dryers? In this example, they do. However, nobody's going to put a washer and dryer in their attic. So in this case, they're not elevated above the first floor, so they're not getting the discount. And that would be the same as true for your air conditioning units, water heaters. Normally, everything's not up in the attic, so you won't get the discounts for those items. So as far as the rating, there's a couple of methods that you could use to rate a policy. Basically, we go in like we just did and plug in all of that information without using an elevation certificate. And then we hit go and it gives us the rate. No elevation certificates required, whether the house is above or below base flood area. FEMA's pulling in that data from outside sources and then with what we plug into the system, and then it's giving us a rate. So there's really not a whole lot we have to do in this one. We just plug the information in and then we go forward. The second method is you can have an elevation certificate and use that if they have one. In some cases, it can be beneficial to have an elevation certificate, because if FEMA's system is showing that your house is below base flood elevation, but you have an elevation certificate, using that elevation certificate showing that it's above can actually lower the rate. And I think that as you go above the base flood elevation, I think 4 feet is the max, but like if you're a foot above, it's a certain discount. If it's 2 feet, 3 feet, 4 feet, you get bigger discounts. But once you get over a certain foot above base flood elevation, it's just the same. So it can give you a better rate. So you can use those to determine the structure's elevations and to determine what is the first floor elevation above ground level. But some of the things that we've seen is that we've plugged in an elevation certificate and the rate actually went up. So what we did is we just removed it and then went with whatever their basic rate was. So if you ever get a quote from an agent, it's in, let them know that if they run it with the elevation certificate to see if it makes a difference, and if it makes the rate go up, obviously you're not going to use it. And then again, elevation certificates still are required if you build a house in a high hazard flood zone. You will be required to get an elevation certificate and build it above that zone. Okay, so if we have an elevation certificate and we plug in that information, we're just pulling the information right off the elevation certificate. They want to know when the signature date was on the certificate. The reason that they want to know that is that in order to use an elevation certificate, you can use one from several years ago. They have, once you plug in that information and tell them what the date is, they'll automatically do a datum conversion for that date. The other thing too is if you use an older certificate, then you have to have current photos. So they want photos within the last 30 days. I believe it's 30 or 90 days of getting the policy. So if you use an older elevation certificate, which a lot of counties and municipalities, they have these certificates on file. So a lot of times when a customer calls me and they buy a house and they're in a high hazard zone, a lot of times I can just call the local planning authority and I can get those elevation certificates for them in most cases. Again, it's asking what the elevations are, what the diagram numbers are, and then on the bottom, it's asking you what is the top of the bottom floor. So again, we're just pulling this information directly off of the elevation certificate and plugging it into their system. For elevation certificates, these are what they typically look like. So on an elevation certificate, it's going to tell you what your diagram number is. In this case, it's shown as a 6. That's normally an elevated building with, I believe, with an enclosure underneath it. 1A is a building that's on a slab on ground level. 1B, I think it's an elevated slab. And then also too, if there is an enclosure on the bottom, it asks you, is there venting? Do they have proper vents on there? So that's where the elevation certificate, you get that information right off their system and they can tell you, are they engineered flood openings or not? Also, same thing for a garage. If you have a house that's kind of built up a little bit and you've got a garage, they also want to know about venting on a garage, if that's available as well. Section B of the elevation certificate normally gives you the base flood elevation. So in this case, it's 16 feet. And then section C, it'll tell you what their measurements are for the top of the bottom floor, the next highest floor if it's a 2-story house, And then what we normally pay attention to is A, what is the top of the bottom floor measurement? And H, what is the lowest adjacent grade? So lowest adjacent grade is just basically the ground level. So if whatever the lowest point is ground level that's touching the house, that's what they're going to put on here. So in this case, it's 11.5 feet. The house is 12 feet, which means it's about a half a foot off the ground. In this case, the base flood elevation is 16 feet. So this particular house, what they're rating it, top of the bottom floor, means it's 4 feet below base flood elevation. So that will have an impact on the rate. When you're building a house and you see what that base flood elevation is, a lot of engineers use their certificates based off of construction drawings, and then they can put in there, based on the construction drawings, what that elevation will be to make sure they're up to code. And then once the building's done, they go back out and then they give you a finished construction elevation certificate just to confirm those numbers that they had before. So what are some of the things that we're seeing in, this is primarily in Mississippi Gulf Coast, but we're also seeing this in Alabama, really any coastal area. There's different scenarios. First scenario is that if somebody comes in and they're buying a house, the house does not have a flood policy on it, it goes straight to the risk rating 2.0 rates. Normally those rates, what we're seeing in AE and BE zones, they're normally a little bit higher. And then in X zones, it just really depends on your distance to a source of water. Like we were talking about that area up in D'Iberville, a subdivision, where we're seeing houses that are in an X zone that were normally around $600 for a flood policy. They're now about $3,000 for a policy just because they're so close to the river. If there's a prior flood policy that someone has, and they're either assuming that buyer's assuming that policy, or they have a prior flood policy in effect before the risk rating 2.0 started, then the legacy rates are normally going to be lower, a lot lower in most cases than what you're seeing over risk rating 2.0 standard rates. And instead of just taking everybody and making them go full risk rating to the full risk rates, they're gradually bringing everybody up to that level with an annual cap rate and discount that Allie was referring to earlier, until you get to the full risk premium. So that's what that annual cap discount rate means. It just, anybody who was on the legacy rates, they're going to gradually bring you up to that full risk premium over time. And again, if someone's purchasing a home and someone already has a flood policy and they're getting the benefit of those prior legacy rates, even though they're going up 18% every year, and most times it's a lot cheaper to assume that policy than it is to get a brand new one. So Allie had an example of this. So again, full risk premium is what the rate is under risk rating 2.0 if you were to buy that house right today. The discount is where you are in the legacy rates, and they're showing you what the difference is between what you're paying under legacy rates and what you would be paying under full risk premium. And every year that'll go up no more than 18% until you get to that full risk premium. Now, just keep in mind that full risk premium is not a standard, is not a static number. It's going to move. So we see the NFIP rates going up, 5, 6, 7% every year. So you're actually chasing a moving target, but the 18% increases are eventually going to catch up to it because the flood rates are not going up that much. So national flood versus private. So we use an example of a house being in an X zone. So in this particular case, I ran a property that was here in Jackson County, and I used it on an X zone, just using standard limits of 250,000 for the building, 100,000 for the contents. Again, there's a 30-day waiting period under the NFIP, and then policies can be transferred from sellers to buyers. So that's what you're seeing on NFIP. What we've been finding is homes that are in an X zone that are close to a water source, their rates are much higher than what they were if they were getting those preferred rates for being in an X zone. In this case, I think I ran this property, it was at $979. Neptune Flood Residential Flood Program is one of the private flood carriers that are being used. There are several others, and there's even more that are coming in. There's a company called Orion 180 who does homeowner policies, who just this year started adding a flood component to their policies, where they're actually insuring it themselves. Coastal American Insurance Company, I believe they write both in Alabama and Mississippi coastal areas. Depending on where the property is located, you could actually get flood coverage in the policy. But there are more companies coming in that are offering private flood companies. These policies are more like a homeowner policy. They're backed by insurance companies. They're not backed by the federal government. The replacement cost values, you're not limited to 250 per building or 100,000 per contents. In some cases, you can go up to $1 million or $2 million for the building. And a lot of times there's like a 10-day waiting period, regardless of if it's a loan or not. So they will have, in this case with Neptune, it's a 10-day waiting period. And these policies are non-transferable. And as you can see with this policy, it's the same property. Running it through an X zone is $596. So it's actually cheaper than what the NFIP policy was offering. So with that said, I think I'm kind of right at my time. That's the rating program basically in a nutshell. If anybody has any questions, I'll certainly be happy to answer those.
Thanks so much, Stephen. I did drop in the chat when you were talking about some of those discounts. I put a link to FEMA's like discount explanation guide for that if people want to see the details of that. So that's there, just so y'all know. But does anybody have any questions? You're welcome to drop them in the chat, or I think Kiama is making it so you can unmute yourselves and ask any questions, but feel free. You're welcome, Maurice. Thank you for attending. I got to thank you on our comments. Y'all are more than welcome to ask questions and pick our brains about, anything you've experienced, or, questions you want to work through, because I know there's just been a lot of, interesting scenarios that have come out of this that people have come to me to talk about. So if you guys have anything that's come across your plates that you want to, or we're happy to chat about that.
And I will say, I know I went through this very quickly, and if anybody does have any questions, I'm sure Allie can provide you with my contact information. If you want to call, it doesn't have to be getting a policy or anything like that. If you've just got a question about this, or if you have someone you're working with that's running into a situation and you don't know how to answer it, if you've got some questions, I'll certainly be glad to provide any assistance that I can. So feel free to call, email, text me. I'm available, and I can certainly help answer any questions that you might have.
And Kiama did just drop an evaluation for this training link in the chat if you want to give us your feedback on this. Like I said, we plan these based off y'all's feedback, so we'd love to know what you liked, you didn't like, things you'd like to see us offer in the future. There's spots for that on there too. So we'd love if you can click that Google link and tell us what other kind of trainings you want to see related to this topic, or just on resilience in general. But I think there's, a lot of conversations that are relevant, here, especially insurance after this crazy hurricane season. I think a lot of people started to have some more questions about flood and just insurance relating to hurricanes in general, and really highlighting the fact that a lot of people outside the special class hazards flood area do flood. And, so for someone who is trying to help communities build their resilience, just this understanding of the risks that we all have and what we can do to mitigate that is a conversation that seems like it's always ongoing. I have a question for you, Stephen, because it's bopping around my brain about this. Do we know how many private flood policies then are being written in these areas? As we're seeing these changes between NFIP and stuff, is there data available on that?
I don't have specific numbers on it. I can only tell you from our agency what we're seeing on a percentage wise. You're talking about that 20% of
Mm-hmm.
policies being lost to the NFIP. I would say that we're probably seeing a lot more people go to the national or to private flood companies than National Flood. And here's the thing, we were talking about the policies that are going with the annual cap discounts. At some point, because I've seen premiums that where people are paying $1,000 now, but their full risk premium is like $6,000, $7,000. At some point, there's going to be a crossover from what the level of National Flood is offering and what private flood companies are offering, not only in coverage but in premium. There's going to be a break-even point there, so they're going to cross over at some point. If they're even, we normally tell people stay with the NFIP until it gets to a pain point that you need to change because of rates. And
Right.
at that point, we can bring in a private flood company to write that policy. Because if you're with National Flood, you're backed by the federal government. So we encourage people to keep those policies and to renew them. If somebody's has a legacy policy and they're getting that annual cap discount, if that policy lapses or cancels for any reason, even if it's just a day, they lose those legacy rates. It goes straight to risk rating when you have to redo it. So a lot of times we're seeing where something happens where the mortgage company doesn't pay the bill, the policy cancels, and then we have to go with another policy. NFIP is too high, so we're going with a private company. So I would say, you're seeing about a 15% increase in people going to a private flood company. The unfortunate thing is people that are on fixed incomes that are feeling this and their rates are starting to go up when they no longer have a mortgagee on the policy, they're just self-insuring for flood. And that's the
Yes.
unfortunate side of the flood that we're seeing. But unfortunately, if you live in a high hazard area like a coastal market or on an island like on Dolphin Island or some other places like that, you're going to see higher rates just simply because of where you're located. And unfortunately, we are seeing people that are on fixed incomes that are unable to afford it, so they're self-insuring, and not only with flood but with wind as well. So we're seeing
Yep.
that prevalent too. So hopefully, National Flood is federally regulated. Congress makes decisions on what happens, and if enough people raise enough concerns, then if it starts to affect those people in Washington, then I think you could start seeing some movement, whether it's changing the FEMA rates or the FEMA mapping, or if it's just making the rates, how they're going to do the rates.
Yeah, and we are getting new maps in our region, so that will be, we're due for an update on that. So that'll also be interesting to play into this. But yeah, in my work and the folks we talk to, like, we do see a lot of those conversations about people like, yeah, choosing to self-insure, or a lot of the folks that are kind of on that cusp, but they're not required. They still have a mortgage, but they're not required. So they're paying for flood separately because it did used to be a bit cheaper because of the legacy system. But now because their risk is much higher because they might be an X, but they're like right on that, border there and they're pretty close to the water, then they're saying, oh, but it was one thing to pay a couple $100 for it, but if it's going to be like thousands of dollars, but it's kind of this trade-off in these conversations where like they sort of recognize they're more risky, but also like they might have purchased the house thinking this is how much I'm going to be paying. And as we're seeing other insurance go up, like you mentioned, the wind and the other hazards and stuff, that people are, definitely having to make some financial decisions, which from a resilience perspective and thinking of like what our communities are doing, this is like a conversation that I think is going to keep occurring for a while.
Yeah. And I'll add one more thing that I didn't really cover in the presentation. A lot of people don't think about the substantial damage doctrine that's built into these flood policies and into a lot of local building codes, is that if you have a house, and I can tell you Pascagoula is affected by this, and a lot of other areas that were not in high hazard zones, and when the maps changed, the entire city went under basically into a high hazard zone. What people aren't considering when they're selling homes and when people are buying homes is that if that property had any damage to it from flood or even a remodel, so let's say you buy a house, it's on a slab, it's below base flood, and you decide you want to remodel this home that you just bought. Well, if the remodeling cost is more than 50% of the market value of the home, city code will require you to elevate that structure above base flood. We've seen people that have had homes that had a fire loss in their house, where they had a kitchen fire. It didn't totally destroy the home, but it gutted part of the inside, and the cost to repair it was, say, 60% of the value of the home. Well, the city is requiring, or local municipalities requiring, that you elevate that structure above base flood or tear it down and rebuild it. And a lot of people don't understand that insurance doesn't cover that. You do have a building ordinance of law coverage that's normally 10 or 25% of your dwelling limit, that if you have a covered loss under the homeowner policy, and code requires you to improve that building because of the loss, then there's some coverage, even if it's, a fire loss, and then you're being required to elevate it above base flood. There are some coverages in a homeowner policy under your building and ordinance of law coverage that will provide that. I think FEMA also provides a program where they offer, I think it's like $35,000 to help elevate a structure if they need to, but in some cases it's just not enough to do that. And so you see homes that are sitting in these areas that are gutted out, and they're just a shell of a home, and they're just sitting there, and nobody can do anything with it because you have to elevate the structure. And so a lot of people don't consider that when they're selling a house, and when they're buying a house. If they're buying a house on a slab below base flood elevation, they're getting a great deal on the house. But if they decide to renovate it, or if there's a loss, or there's been a loss in the past, and now you have another one, or you're renovating it, and those total in the last 10 years puts it over, then you're basically going to have to elevate that house. And a lot of people don't understand that.
Yeah. Yeah, that's definitely, that's where a lot of this like nuance comes in, and people, I think they want it to be pretty black and white in their understanding of it. And, I've definitely talked to some realtors and things who have said like they've had, deals fall apart and things as people, learn these sorts of things over time too. So lots of concerns there. Well, thank y'all for coming today. We're hitting just 10 o'clock on the nose. So please do that evaluation if you haven't, and make sure you've dropped your email and name in the chat if you wanted those continuing education credits. But otherwise, have a great morning. Thank you for joining us. And if you have any other questions, y'all can reach back out to us. I know Kiama has emailed all of you coordinating this. We're happy to get you in touch with Stephen or then anybody else if it's a question that we can help answer. And as always, we're doing more trainings coming up this year. So if there's something you'd like to see or an extension of this, there's more things we could be covering, please let us know in that evaluation, and we'll be happy to put together more training so we can continue this conversation. Thanks, y'all. Have a good morning.